Hello and welcome to this week's podcast, brought to you by the Good Money Guide and our sponsors Pepperstone, who are a multi-regulated CFD broker providing trading services in Forex, stocks and commodities in multiple destinations. My name is Michael Hewson and joining me again is Pepperstone Senior Market Strategist Michael Brown. Hello Michael.
Very good afternoon to you, mate. How are you doing?
Good, not too bad, mate. Not too bad. Slight difference in tone this week after the records of last week, the records of the DAX and the FTSE. While US markets have made record closes, we've seen a little bit of softness in European markets. So what do you put that down to? Before you answer that, here we go.
We almost forgot again.
We almost forgot. So before you answer that question, let's do the risk warning before your compliance gets upset. Before your compliance gets upset with me. So risk warning: the information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers or listeners of this content to seek their own financial advice. Spread bets and CFDs are complex financial instruments and come with a high risk of losing money rapidly due to leverage. 75.9% of retail investor accounts lose money when trading spread bets and CFDs with this provider. So the floor is yours.
Indeed. Now that's out of the way. It has been an interesting week. Obviously, as you said, record highs on Wall Street, a little bit of softness coming in Europe. I mean, fundamentally, the market's kind of been struggling to latch onto a specific narrative. I think the data docket's been very, very quiet indeed outside of the UK. There's been a lot of noise geopolitically. I know defence stocks have traded well, which you want to touch on in a short while. And I think a few other risks are coming into the Eurozone outlook as well. I mean, one thing that really hasn't been discussed is the elections that we've got coming up in Germany this weekend. So maybe just a little bit of caution coming in ahead of that as well. But it does feel like markets have kind of become desensitized to the daily rants that we're getting from President Trump and are almost seeking something a bit fresh to latch onto at the moment.
Yeah, I think one thing I did take away, from this week, Michael, was the fact that while we've seen weakness in European equities, I think that's coincided with a rebound in yields. And I think that's potentially why we've seen a little bit of softness, particularly in the FTSE 100, which hasn't really had a great past few days. The DAX is also a little bit softer. I think on the back of comments from ECB Governing Council member Sabine Lautenschlager, who's basically indicated that she thinks that the ECB is pretty much done when it comes to cutting rates, and that's prompted what I would call a little bit of a realignment in rate cut expectations from the ECB, but also this week's UK inflation, wages and unemployment data from the Bank of England.
Yeah, just on that, I mean, we'll go on to the UK data in a second, I'm sure. But on the ECB, I would love to know what anyone is looking at in Eurozone data at the moment to go, this economy doesn't need any more rate cuts. To me, it's slightly bonkers to be talking about the ECB bringing their easing cycle to an end when the deposit rate is still above the top end of where they think neutral is. There's still a risk that inflation undershoots target, and you've got the potential for tariffs to be thrown in from the 1st of April when these supposed reciprocal tariffs are set to go in. So, yeah, I think that it's an interesting view, but I'm not sure it's one that represents the consensus among ECB policymakers.
Yeah, but let's be honest here, Michael. I mean, with a rate of 2.75%.
Well,
how much lower can they take it? And let's face it, you said it before, and I'm going to say it now. They could probably cut rates by another 2%, and it wouldn't make any difference.
Yeah, that is incredibly true, and I do still stand by that. To be honest, wherever the deposit rate is in Europe, it isn't going to make the blindest bit of difference. I guess it's more of a signalling mechanism than anything else. Because as we've seen this week, this hawkish chatter, and we've seen Bund and OAT yields rebound quite significantly. OATs being French government debt, of course. So I guess it's more the signal that the ECB are sending as opposed to the actual level of rates that's the key. But anyway, here in the UK, I don't know about you, but I don't think we're getting another rate cut anytime soon. May at the earliest, I would imagine.
Yeah, no. I mean, I can't see May. I wrote a piece on my Substack earlier this week, and to be fair, when you've got wages at 5% and you've got core inflation moving higher along with headline CPI and a whole host of tax rises and minimum wage increases and business rate reductions or whatever coming in April the 1st, along with broadband price increases, council tax price increases.
Energy will go up again. Can you really see the Bank of England cutting rates just before the inflationary effect of those measures starts to manifest itself when the numbers for April and May are released in May and June? Well, given that it's the BOE, yes, I can, because they're a complete clown show. If it was you and I running monetary policy, then you would take a more measured approach, and you would indeed wait for the impact of all of that to become clear. But I think the BOE are resolute in this view that, and I must admit, I did mock them a little bit on the internet earlier in the week, but they seem resolute. Exactly, I know, it's a shock. They are resolute in this view that inflation is going to get to 2% in 18 months. Now, that 18 months has been 18 months away since the start of 2021 and is now the end of 2027. But even so, that is their belief. And I think it's a classic case of, you've got to look at what a central bank is likely to do rather than what we would want them to do. Because I think the BOE are likely to continue with this gradual, predictable pace of 25 basis point cuts per quarter, even though I think pretty much I would almost wager everyone I speak to in the city is saying they probably shouldn't have even cut by as much as they have, let alone be looking at more when you've got CPI running at 3%, probably getting closer to 4% as we move through the year. Earnings pressures are average hourly earnings are 3 times the bank's 2% inflation target. Just look at those two metrics alone and you'd go, stay the hell where you are on bank rate until things calm down a little bit.
Yeah, and I think that's why I just can't see the rationale if inflation is heading higher, why the Bank of England would think that it's okay to cut by 25. I think the cover for that has gone. I think if they were going to do 50, they should have done it when Catherine Mann did her screeching handbrake turn last time out. Now they really don't have the luxury of, they're almost sending a message by cutting by 25 that they're not bothered about inflation. And I'm not really sure that's a message they want to send. And he's talked about a bump in the road or a hump in the road. Is this the new transitory?
Well, I think he even said the word temporary at the February press conference. I know you were on a flight at the time, but again, we've gone through this before. We went through this over COVID. Inflation's temporary. It clearly bloody isn't. Pardon my language. I think the interesting point you made though, and I think this is a message that every G10 central bank has sent, is that 2% is now the floor rather than the ceiling in terms of inflation. And everyone has implicitly sent that message by delivering rate cuts, whether it be 1 or whether it be 5 in the case of the ECB, by delivering those cuts when inflation is not projected to get to that target for another year or two. Everyone is kind of saying that, actually, I think central banks, the trade-off that they're making, and you can debate this till the cows come home, the trade-off that they're making is, do we tolerate slightly higher inflation to support growth? That seems to be the psyche. Whether or not it's right or not is a completely separate debate. I would say it's not. The BOE's mandate is 2% inflation, and it's not to bail out the government because they don't know how to manage the economy.
And that's my point. They're not the Federal Reserve. They don't have an unemployment mandate. They have an inflation mandate. Yes. And ultimately, it's not the Bank of England's job to bail out the government. Having said that, obviously they needed to, if financial conditions deteriorate, that is their job.
Yes,
so,
of course.
There is a crossover between the two. But for me, I think financial conditions, they're probably looser than they were 6 weeks ago. But that wouldn't be difficult given where gilt yields were then. Having said that, I'm still not convinced that the Bank of England will have enough data to warrant a 25 basis point rate cut. But, as I say, I've been wrong before, but I just think that it would be irresponsible for them to cut rates. And I think, could well be a very significantly split decision, I think, particularly if the data continues on CPI the way that it has done over the course of the past month or so.
No, I think you're right. It's famous last words. It's not going to be 9-0 for another cut. I don't think, because I think upside inflation risks will be a lot more prevalent at that point, and also what economists would rather fancily term second round inflation effects. The risk of those is going to be a lot higher as well, effectively where these transitory shocks turn into a more prolonged increase in prices. I think that risk will have risen quite considerably by the second quarter as well.
And you mentioned it yourself, possible tariff risk. So, and the Fed minutes last night underlined that risk. Trump wanted his rate cut. Well, he didn't get it because Fed officials were worried about tariffs' impact on inflation and see rate cuts on hold. So, for me, if the Fed's thinking that and people are talking about potential rate hike, I certainly don't think that's on the table at the moment. But certainly it's something that, it's a discussion that's being had that wasn't being had at the end of last year. I think it's going to be a very, very difficult situation to really say with any degree of confidence that the inflation genie is back in its bottle. And I think it could well be more persistent than people are perhaps possibly pricing in. And certainly here in the UK has always had a much more persistent inflation problem than, say, for example, the US. And because we pay an awful lot of what I would call, we get an awful lot of imported inflation due to the weakness of the pound and the fact that all commodities are priced in dollars. So sterling weakness is always going to act as a little bit of an inflationary input to the headline number.
You're absolutely right. But I was going to say the one, I guess, very small silver lining of how markets have traded over the last couple of weeks is that the dollar is actually a fair chunk softer and cable is still keeping its head above 126. So that may lessen some degree of the imported inflation aspect. But, just sticking my head out a bit, I see absolutely no reason for cable to be at 126 for any particular length of time. So if we start to see the pound roll over, then that's another problem for the BOE to deal with.
Yeah, I mean, I still think, I think we could probably see a little bit more upside, maybe towards around about 128 on a technical basis, because that's where the 200-day moving average is. And looking back at the lows back in January, the dips have been higher every time, which suggests that potentially the cable is, the market is short of cable. So we could see a little bit of a squeeze higher there, and that could actually push the FTSE back down to around about 8,600 or even 8,500 in the short to medium term. Doesn't alter my bullish FTSE call, but I think given what we've seen since the start of the year, we've seen some fairly decent gains, and maybe there's time for a little bit of a pullback there, perhaps in the short to medium term.
Yeah, potentially. I mean, it hasn't been the best week for the FTSE this week, not only in terms of price action, but also in terms of yet another news story that one of London's most significant firms may be looking to leave the market, and that is, of course, Glencore. Now, before we go into that, it's worth just to contextualise Glencore. They are the 16th biggest stock in the FTSE 100, but more importantly than that, when they listed in London back in 2011, they were the biggest IPO the city had seen at the time. And what are we, 14 years later? Their CEO saying, we're probably off to New York.
Yeah, I mean, I remember writing about Glencore's IPO back in the day.
Showing your age now.
I know. remember it very clearly and getting asked about it. But I also remember that it got off to an absolute flyer and then absolutely tanked. Now we're basically talking about the 16th biggest company. We do have previous BHP left in 2022, now we're talking that Glencore could well move, and there is some vague chatter that Rio Tinto might also consider, though that has been dismissed by Rio Tinto management. But I think it's emblematic, this Glencore discussion, of the discussion that we were having at the end of last year with respect to Shell. and BP, and the fact is that the UK is no longer viewed, or is slowly losing its luster, shall we say, as a place to be for big large scale investors, and that's that's really disappointing.
It is. It really is. And I think, you're absolutely right. It does become a little bit self-fulfilling where, it's a sort of slow drip and then all of a sudden it's a tsunami, where all of these large firms are saying, there's no point us being here. And I don't want to rehash the arguments that we had earlier in the year because, to be honest, they're all completely valid still. But
people always can listen to them back. So,
Exactly, and please do. The one stat that I did find this week, though, is that over the last decade, the LSE has lost 25% of the companies that are listed on the exchange. And that, for those wondering, that's not 25% by market cap, that's 25% by individual number of companies, which is, quite frankly, a shameful statistic.
I wouldn't say it's the LSE's fault, though, would you? I mean, it's down to the governments of the day, undermining, the attraction of the UK as an investment destination. And now we've got the Chancellor, Rachel Reeves, looking to, going slightly off piste here, reduce the cash ISA from £20,000 to £4,000. I mean, I've said it before, and I'll say it again. You make the UK an attractive place to invest, and people will invest in stocks and shares ISAs and not cash ISAs. It's not rocket science, and, she can have all these summits with BlackRock, fund managers. She can have as many of them as she likes. We all know what the solutions and the answers are. This government is choosing not to listen. Why do you need a bunch of expensive advisors from central banks and fund managers to tell you what's as obvious as the boil on a backside? It's crazy stuff. It's basic economics 101.
Yeah, no, you are exactly and absolutely right, mate. And actually, this business of the cash ISA, and for those people who are unaware, there were reports, I think, by the Telegraph earlier in the week that the annual limit could be lowered from 20 grand, where it currently stands, to 4 grand, which would be a pretty chunky reduction. I think there's two things that have annoyed me about that. The first is that, as you rightly say, if the market is strong enough and attractive enough, you don't need to force people to invest in it. They will invest in it anyway. And that's the same argument I would use in terms of the whole pension fund and county council investment, all the rest, all that other nonsense. I think the broader point, though, is there are sort of certain assumptions that are made when it comes to particularly financial planning in the UK. And I know pensions is obviously a significant area in this respect, whereby there are schemes and initiatives that the government put in place that there is a common understanding that they won't change over a period of time, to give people that certainty to plan 2, 3, 4 decades in the future.
Confidence.
That confidence, exactly. And Rachel Reeves needs to be very careful here, because at the budget in October, she undermined confidence in pensions by changing the tax treatment on a lot of pension pots. We're now looking at a spring statement where Rachel Reeves could be changing the rules around the cash ISA. I would posit that this is a very dangerous and potentially a very slippery slope for the UK government and the UK economy to be going down, because it doesn't take, the most vivid of imaginations to go, well, we've changed the limit on the cash ISA, so shall we now change it on all ISAs and do stocks and shares as well? At which point you are undermining practically any confidence that anyone has in the ability to make longer term financial plans as a UK resident. And I think that's a real worry, and it would be incredibly foolish if the government did go down that route.
Well, it's not going to make the UK any more investable, is it? Because ultimately, I think what investors crave above all else is, confidence that they're going to get their money back. And you've seen the effects that, sort of overt government intervention has in the Chinese stock market. Yeah. To my mind, China is uninvestable because ultimately there's no guarantee that the government won't stick their fingers in and you might not get part or all of your money back. And as you say, confidence is hard won. London has its reputation as a financial hub. simply on the basis of trust and confidence in the UK government of the time, but also the institutions of the UK.
Mm-hmm.
You start to fiddle about with them and you'll bring the whole lot crashing down.
Exactly. It's confidence is very hard won, but it's also very easily lost.
Yeah,
and
exactly
of
right.
course, that's not a route we want to go down. But anyway, shall we move on?
We'll move on. Okay, so I mean, basically, we've seen a little bit of weakness this week in European markets, but one sector that's done particularly well has been defence. Not surprisingly, obviously, Donald Trump has signalled a retreat, shall we say, from funding Europe's defence requirements, the US defence umbrella. And to be quite honest, I can see his point. When you look at NATO funding, the US funds around about 71% of NATO spending. And Europe is basically, behaving like the child at the kiddie table when it comes to its response to some of his comments. Now, obviously, some of his comments regarding Ukraine are slightly deranged, shall we say, but let's move beyond that. What we have seen is we've seen the likes of BAE Systems and Rolls Royce experience a bit of a pop, because obviously they're two very key defence procurement providers and what have you. BAE Systems at record highs. Obviously, there was an awful lot of concern about ESG and DEI, which steered investors away from defence stocks, particularly as a sector, because it wasn't considered ethical, shall we say. Yeah. Don't even get me started on that. But, for me, I think the narrative has shifted. Since Russian tanks rolled into Ukraine, BAE Systems share price has more than doubled. I'm going to write something about defence as a sector, and some smaller UK companies which are front and centre when it comes to innovation, technology and defence, and are not probably as widely known as, say, BAE Systems are, and Rolls Royce. Obviously, they're also a key defence contractor, and there's three of them, and I don't know whether you've got any thoughts on any of them, but they're all listed on the FTSE 350. Babcock, which carries out engineering support for ships and submarines for the Royal Navy, helps manage naval bases as well as other defence equipment. Kinetic, science and engineering, again based in Farnborough, consults on cyber security, develops weapon systems like the new Dragonfire laser, which the Royal Navy hopes to use on its ships in 2027 to shoot down drones and missiles, assuming it has any ships left in 2027.
Well, yeah.
And then you've got Chemring as well. I mean, all of those three have really underperformed relative to, say, BAE Systems and Rolls Royce, and I certainly think they're probably worth a look, if just not for the fact that European governments are likely to have to spend a hell of a lot more when it comes to their defence requirements over the next 4 or 5 years.
Absolutely, I would fully agree with you on that, and I think they're very good names to select. I think there's a sort of three other points I would make. The first is that I'm surprised that people are surprised by all of this. It's been obvious even during Trump's first term, he was saying Europe needs to spend more on defence. Other countries in NATO need to pull their weight. Now, I think some of the things that he said this week are clearly abhorrent and deranged is quite a good way to put it. But actually, some of the other things he said, particularly in terms of defence spending, are pretty much on the money, albeit probably not delivered in the most tactful way. So I think that's the first point I would make. The second, how the hell that's caught people on the hop, I don't know. And this summit that EU leaders were hosting on Monday was quite frankly embarrassing. I mean, you should have been planning for this months ago. The second point I would make, just going back to defence stocks broadly, you would expect them to do very, very well now. I think it's a given that defence spending is going to have to rise. And I think the sector is going to go from being not necessarily hated, but certainly unloved during the ESG heyday to now becoming a very, very crowded long indeed as governments increase their spending in the sector. And I guess that brings me on to the third point, which is that no one seems to yet have considered how the hell governments are going to pay for this. Now, there are rumours in the British press this morning, Thursday, that the government may be looking at tax hikes in order to fund an increase in defence spending. That feels like a bit of a trial balloon, to be completely honest with you. In Europe, I think one of the other factors that's been pushing yields higher this week, as we were discussing, is the market saying, well, you're going to have to increase issuance because if you want to spend more on defence, you're going to need to get the funds from somewhere. And I think we're seeing the fixed income market react to that possibility as well. But that's something that's worth considering. Is it financed by taxes? Is it financed by borrowing? Or is it financed by budgets being trimmed elsewhere? But from a pure equity perspective, I think the defence sector is going to be shining.
Well, I can find the UK government £18 billion straight away. Tear up the Chagos Island deal and spend it on defence instead.
God, I'd forgotten about that, actually. Yeah.
There you go, 18 billion straight out of the box. Job done.
And Hewson for Chancellor.
I don't know about. Did you say Chancellor or Chancellor?
No comment.
Yeah, I think there's only one person who's a Chancellor, and I don't think it's you or I.
No, that is very, very true.
Okay, so let's move on to this week's big announcements from Lloyds and HSBC. HSBC was a bit meh, it was okay. They announced another buyback. The numbers were good again. What was notable, I think, with HSBC was the Asia Bank did very well, and the UK bank saw a slight decline in profits, but nonetheless, they still posted a decent set of numbers. But it's the reaction of Lloyd's share price today. It's up 6%. To highest level since 2019. Maybe that's 69. Remember that discussion we were having about?
I knew you were going to bring that up as well.
Yeah, well, why would you not? I said it at the time. I felt Lloyd's was undervalued. And here we are now. We're within touching distance of those December 2019 highs at 69.9p. Looking at the numbers, 5% fall in net income, a 20% drop in annual profits. But actually, when you look at it, they've obviously increased the provisions in respect of Black Horse Finance. Eminently sensible thing to do. They may not be anywhere near as much as £1.1 billion, but that's the provision they've set aside. £450 million a year ago, £700 million now. Looking at the business itself, nothing to scare the horses there. Customer deposits are higher from a year ago, 10 billion higher. Loans are also higher, and margins slightly lower from a year ago, 2.95% down from 3.11. But what was particularly notable about the margin number was that in the last half of the year, net interest margin was higher than it was in the first half of the year. I wonder why that was. I know the answer to that question.
I was going to say, why don't you enlighten us, Mr. H?
It was the higher gilt yields, wasn't it? So,
indeed it was.
That's what prompted there. So, looking at the bank, they've raised the dividend again, 15% raise in the divvy, and a buyback of shares of £1.7 billion. Now, they wouldn't be doing that buyback if they were concerned that any compensation from Black Horse Finance was going to be any higher than the provisions they'd already set aside. Now, obviously, the court case isn't until April, but I think the message the management is sending is that, there are clouds on the horizon, but they think they've got it under control. And even though the outlook is tricky, their guidance was fairly positive. Underlying net interest income is expected to rise by £700 million to around about 13.5 billion. So, all in all, I think Lloyd's is in pretty good shape, and it's still in better shape than it was 10 years ago when the share price was higher.
Indeed, as you've said before, I think that was your sort of final point there was probably the biggest takeaway for me, was that, they've increased their dividend, they've given us a buyback, they've increased their provision as well, and the results are pretty decent. And I think that's just given the market a little bit of reassurance that actually, as you rightly said, yes, there are these issues on the horizon. Yes, this motor finance scandal is not going to be going away anytime soon. But even so, it seems like the bank is doing okay. They've set aside what they think they need to set aside. Everything else is ticking along pretty nicely. They don't seem particularly concerned, and I think that's leading the market to go, maybe we shouldn't be as worried either.
And hence the fact that the share price is up 6% at just over 66 pence.
Mm-hmm.
So at the moment, for me, I think there's nothing to be overly concerned about. But things change very, very quickly, and that's the key. You just keep an eye on it, and hopefully we'll see a continued acceleration in the share price. And ultimately, Lloyds Bank, of all the big UK banks, has been the one that's really performed the worst relative to NatWest, Barclays and HSBC. So I think it's due for a little bit of catch up.
Yes, I think I agree with that.
Okay, so that's pretty much what we covered last week. Let's have a look at, you've mentioned the German elections over the weekend. There's been an awful lot of talk about the AfD and what have you. I probably know a little bit about the German electoral system. And even if they do well and they get 23% of the vote, I can't see them having a significant say in any new government, because the other two big parties will coalesce around a position that blocks them.
Yeah, you're absolutely right. I think it's more than that. Actually. I think it's all of the other political parties in Germany have said that they will not go into a coalition government if the AfD are involved. I think the bigger question is, their vote share is still important because, firstly, who do they win votes from? And secondly, if there is a big surge in support for the AfD, and as a result there is less support for the other parties, that means that the governing coalition that eventually is formed is going to be more fragmented, is going to take longer to form that coalition as well. And the third thing to bear in mind is one of the big issues that could be up for debate in this German parliament is the idea of reforming the debt brake, which is, of course, the idea that basically Germany doesn't run a budget deficit. In order to change the debt brake, you need a 2/3 majority of seats in the German parliament.
I just can't see. Yeah, how are you going to get a consensus around that? Yeah, it is. I think things have to get an awful lot worse. So I think we could well get a new German government at some point. But I seem to recall the last time we had these elections, it took over 6 months, before we actually got a coalition of sorts in place. It was a while, if memory serves me correctly.
It was a very long time, and I think this time around it's very much the base case that Friedrich Merz, as the head of the CDU/CSU, is going to be the new chancellor. The question is, who joins him in government in terms of the party, and how many of those parties are needed to make a working government. And I think it feels, it feels to me a little bit like the euro is kind of underpricing that. We almost always go German election, it's a bit of a non-event. I think it's a little bit complacent to assume that this time around.
Yeah, I think also coalitions, this particular coalition is likely to be very, very fragile. And I think any decisions they make will probably come out of having to make them as opposed to wanting to make them, and I think that's the key thing, as far as I can tell.
And also, of course, just lastly on that, the coalitions can indeed prove very, very fragile, as we saw with this coalition, and that's why we're having elections, because the whole thing collapsed last year.
So any new German government could well be very short-lived and prompt another election. You just don't know. So, and when's France due to have its elections?
Well, France can't hold parliamentary elections until July, because there has to be a year between the elections. But you would imagine that as soon as that 12 months is up, the opposition parties there are going to be pushing Macron to go to the polls pretty damn quick.
Okay, on that basis, obviously we've got Germany and France fourth quarter GDP. Germany's on the 25th and France is on the 27th, and those numbers aren't expected to be particularly great. And I think Germany's need for some sort of catalyst for growth is probably more needed than, say, for example, France. They've got no effective government at the moment, Germany, and we've got an economy, a manufacturing economy, that's in depression, and an economy that's barely grown for the last 2 years.
Yes, indeed. And I think, the whole thing, we've discussed these structural issues in Europe at some length now, but the other problem that I guess Europe faces is, we spoke earlier about the potential for a trade war, reciprocal tariffs, etc. Europe's trying to deal with that with an economy that basically isn't growing at all and a complete vacuum in terms of political leadership. So, yeah, things aren't particularly great on the continent, and risks to the economic outlook remain firmly tilted to the downside.
So they need a pickup in something. Maybe defence spending perhaps might be the catalyst that
could be the
picks the German economy
that they need.
Yeah, indeed. We've also got fourth quarter US GDP. That's a revision, I believe. We did see a significant fall, I think, in the numbers at the end of January. If you could remind me what that was, I think it was 2.3 from 3.1.
What was that? Sorry.
US fourth quarter GDP. We've got a revision for that.
Yeah, it was 2.3, 2.4, something like that. I can't remember off the top of my head now.
Yeah, down from 3.1 in Q3. But I think a large part of that Q4 underperformance was down to the hurricanes causing significant amount of disruption, but also the Boeing strikes. So if you actually look at household consumption on those numbers, that actually picked up to 4.1 from 3.7%. So we could see a little bit of a bounce back, perhaps, in Q1 after a bit of a slowdown in Q4. So I think the core PCE is probably going to be the more important number of those, I would imagine.
It is, and of course we get the January PCE data on Friday as well. Yeah. And I think that's going to be particularly important because the CPI and the PPI numbers in January were relatively hot. But if you dig into the weeds of that, the components of each of those releases that then feed into the PCE metric, which is the inflation gauge that the Fed like to use, they were actually a little bit on the soft and on the cool side. So expectations are that the PCE metric isn't going to show as intense a degree of inflationary pressures. It's certainly not going to be enough to make the Fed cut or anything like that, but it may just soothe a few nerves a little bit.
Interesting point. We covered Walmart last week. They just released their numbers. The actual numbers were good. The actual Q4 numbers were good, but their guidance was weak. They expressed concern about the potential for tariffs and what have you, and their first quarter guidance was below expectations. So I would imagine that the market probably hasn't taken too well to that. But as I say, I can't
see a headline that they were down about 9% in the pre-market, but I'm not sure where they're trading at the moment.
Well, I can probably tell you the answer to that, but as we go on to that, they are down 6.5%. Big drop. But they have been at record highs, so there was an awful lot of good news priced in there. So not too much of a surprise, probably overdue a bit of a correction. Okay, so let's move forward. We've talked about the German elections. We've talked about fourth quarter GDP. Some bigger earnings announcements next week. I mentioned Rolls Royce earlier.
Yes.
So we got their full year numbers. Remarkable turnaround story there. We've also got Nvidia.
The big one.
The
most important earnings release the world has ever seen.
Until the next one, yeah. Okay.
Oh, of course.
Let's not overindulge it here. Yeah, they're important, but I think it's less about the Q4 numbers and more about their guidance for Q1. And yeah, we've got British Airways IAG 4-year numbers 2024. Again, yeah, whatever. We've also got Berkshire Hathaway. Now, obviously, we did a piece on Warren Buffett a few weeks ago, and we might as well talk about that after we've covered the Rolls Royce, because Rolls Royce share price record high, 4-year numbers on the 27th. I think that's Thursday.
It is indeed, yes.
Thursday. It's been a standout performer. Had a little bit of a pullback in recent days, down 2% today, but its most recent trading update, expectations for underlying profit unchanged at between 2.1 billion and 2.3 billion pounds, along with free cash flow guidance of 2.1 and 2.2 billion. Large engine flying hours have now fully recovered and are at 102% of 2019 levels. It's only taken 5 years to get back there, but we're finally there. And defence is also doing well. Obviously, defence is going to be a key factor going forward. They are supplying the F-130 engine for the new US Air Force B-52J Stratofortress. And obviously the
name, isn't it?
It is, isn't it? And the SMR technology has also been adopted by the Czech Republic. So I think for me, it's really about how does it see the SMR? You know, what's prompting the government to drag its feet over that? Because Rolls Royce has a rich pedigree in nuclear technology. It supplies the engines for our nuclear submarines, the Astute and Dreadnought class.
And they recently signed a new agreement for that as well, didn't they?
Yeah, they have. So, you know, I think for me, despite the fact that Rolls-Royce shares are at record highs, they still appear to be going from strength to strength. And, you know, for me, I think with defence being at the forefront, civil aviation doing well.
Mm-hmm. It's nice to have.
Will they restore the dividend?
I guess that's the big question.
That's the big question for me.
That's what investors will be looking for.
Yeah, it's the divvy.
But it's just nice to have a British company that is innovative, performing well, growing.
Not bad for a burning platform 3 years ago. I mean, what a turnaround.
Quite. Absolutely. They just need the government to pull their finger out and sort the SMR stuff out, and then they could really be flying. But
we'll have an energy policy worthy of the name, perhaps. That would help.
Well, exactly.
So Rolls-Royce, so, you know, optimistic about that. We'll see what happens. I mean, as with anything, I think with numbers such as these, I think there's always potential for disappointment because so much good news is already baked into the price.
Yeah.
You know, I'm looking at the share price now, and you know, it's just a slow glide higher, and we haven't really seen a significant pullback in the last year or two. You know, so maybe we're overdue for a little bit of a pullback. But, you know, maybe towards 600p, but that certainly wouldn't undermine the progress that we've made over the course of the past 2 years. You know, nothing ever goes up in a straight line. So I think the concern I have about Rolls-Royce is that we're overdue a little bit of a pullback.
Yeah, potentially. But actually, you know, given how far we've come in the last 24 months or whatever it is, that sort of healthy pullback would probably be quite good for the stock. Take a little bit of froth out and then allow the rally to be somewhat more sustainable. So, I certainly wouldn't be losing any sleep over that if it were to come to pass.
I think management need to deliver something for the shareholders. And I think a dividend announcement would, I think, help in that regard.
Yeah, definitely.
Okay, so let's talk about Nvidia and we'll finish with Berkshire, shall we?
Let's do that. Yeah, I mean, I think you what you alluded to in terms of Nvidia was absolutely spot on. I think it's been the case for them for some time now. It's not so much about the numbers they report. It's about the guidance. You know, can they keep up this ridiculous pace of growth? And more importantly than that, can they keep up and maintain the, quite frankly, staggering margins at which that business is operating? And I guess the other question that is undoubtedly going to come up on the earnings call is this issue of DeepSeek. You know, if it's a case of people don't need to be buying as many of the latest top-end processors and chips that they can get their hands on in order to build the best AI model, how is that going to impact NVIDIA's business? I think that's really the question that no one's really managed to answer. I know NVIDIA are basically back where they were before that news broke now in terms of the share price, but that's still the question that's hanging over market participants' minds is, you know, is that as big of an issue as we thought it was 3 weeks ago?
Yeah, I mean, let's look at the numbers for Q4. So basically for Q4, NVIDIA says it expects to see a modest increase on Q3 revenues to $37.5 billion. Now, of that amount of revenue that we saw in Q3 was 35.1. So that was a 94% increase from the same quarter the previous year.
It's silly, isn't it?
$30.8 billion of that revenue, of that $35 billion, was data center revenue. So it gives you an indication of how important data centers are to NVIDIA's business model. $5 billion is gaming chips. $30 billion is data centers. And of those chips, there's three: the H100, the Blackwell B200, and the GB200 chipsets. So Q1 guidance for 2026, the fiscal year 2026, is going to be, I think, the key thing here for Nvidia. If it disappoints in any way, shape or form, then I think we could see a significant fallback, even though we've recovered an awful lot of the DeepSeek losses.
Yeah, I think you're absolutely right. I think the
75% margins as well. 75% margins now. Are they sustainable? We talked about that the last time.
We did. And I think the key thing for Nvidia is that any miss or any negative news or any even guidance that's slightly subpar is likely to be greeted very, very poorly indeed by market participants, because you've now got this risk of DeepSeek going on as well. And I think that is really going to be something that participants look at with a very, very dim view.
Yeah, and it's interesting, it actually hasn't recovered back to its peaks on the 7th of January, 8th of January, above $150. So it's around about $137 at the moment is Nvidia. Okay, we'll wrap this up with the daddy, Berkshire Hathaway, Warren Buffett, 94 years old, 95 next birthday. And Q4 2024. Now, a lot's been made of the cash pile, $325 billion, and the fact that he's reduced his stakes in Apple, Bank of America and Citi, as well as American Express. But it's just interesting to note that he has taken advantage of new investment opportunities in recent years. He's just invested $1.2 billion in Constellation Brands, the owners of Corona beer, the old lime in the top.
I should say I had to prop them up in the summer.
Yeah, indeed. Increased his stakes in Domino's Pizza, as well as Occidental Petroleum in the last few months. So he's not retreating from the stock market. He's just repositioning capital. And I think that's the message that I think we need to take. It'll be interesting to see or hear what he has to say about the outlook for the US stock market, because, yeah, he's sitting on a lot of cash. But then again, he could put that money in US Treasuries and get a decent yield off it. So, it's not as if he's not putting that money to work.
Yeah, no, I think you're absolutely right. And the other thing that I would say about Buffett, and I think we probably discussed this a while ago, actually, when we were talking about Buffett, a few months back. And, a lot of people go, oh, well, he's sold this or he's reduced his stake in this. That's not because he's bearish. That's just the way he operates. The Berkshire don't want to be too concentrated with their holdings in one firm or in one sector or whatever it may be. They want to be diversified. And I think the other thing with Buffett, if you look at how he's operated in the past, is he does like to have that cash. Because when the proverbial hits the fan, it means that he is there and he is ready and he is able to pounce and get a deal done that is to the benefit of his shareholders, and probably at a very, very cheap price as well.
Interesting that he invested in Occidental Petroleum, which suggests that he still sees a place for fossil fuels in this so-called renewables era. So
yes.
Far be it from me to bet against the guru. I think my biggest concern about Buffett is, how long has he got left? I mean, he's 94 years old. Who's going to replace him?
His number two, and I've forgotten his name. Anush something or other, I think is his name. But you're absolutely right. That is the big worry in terms of Buffett, is Berkshire's his firm. When he's not there, he's already very sadly lost his right-hand man, Charlie Munger. Yeah. When he's not there, what happens? Does it lose some of that aura? You would imagine it might do.
Well, hopefully we won't have to consider that for a very long time. Anyway,
well, fingers crossed.
Okay, so that's it for this week, Michael. I think we can probably wrap this up. As always, it's been a pleasure, and
indeed.
Hopefully, speak to you same time in the next few weeks.
Definitely. See you soon.
Cheers, mate.